Welcome to Growing Wealth Together, the guide to mutual funds. This video will help you understand the vehicle that drives modern retirement savings. Building a portfolio with individual stocks is risky. Diversification is key. Mutual funds allow you to spread your money across many different investments instantly. A mutual fund is like a pre-assembled fruit basket. Your money is pooled with others to buy a massive portfolio of securities. You own a slice of everything the fund holds. The net asset value, or NAV, is how the price is calculated, once a day at 4 p.m. It is determined by the total assets minus expenses, divided by the number of shares. Active management involves a human manager trying to beat the market. Passive or index management simply matches a specific list of stocks, often resulting in lower fees. Mutual funds offer different goals. Money market funds prioritize safety. Bond funds aim for income. Stock or equity funds focus on long-term wealth building and growth. Target date funds are a set-it-and-forget-it solution. They automatically shift your investments from aggressive stocks to safer bonds as you approach your retirement year. Your money grows in 3 ways: income from dividends, capital gains when the manager sells stocks for profit, and increased NAV as the portfolio value rises. Fees matter. The expense ratio is the annual fee taken out for management. Over time, even small leaks in active funds can cost thousands in retirement. Mutual funds offer diversification, professional management, and liquidity. However, cons include cash drag, end-of-day trading, and potential tax inefficiency. Mutual funds and ETFs contain the same assets but have different delivery methods. Mutual funds are settled at 4 p.m., while ETFs trade like stocks instantly throughout the day. Avoid diversification. Don't buy multiple funds that invest in the same market box, such as 5 large-cap growth funds. That is redundancy, not diversification. Understand the risks. Mutual funds are not FDIC insured. They are subject to market risk and interest rate risk. However, over long periods, the market has trended upward. To buy your first fund, start by checking your workplace 401k. If you don't have one, open a brokerage account. Screen for low-cost funds and set up automatic transfers. Key terms include NAV and expense ratio. The golden rules are: diversify, watch fees, and think long-term. Mutual funds are for years, not days.